Good day, fellow investors. Recently, Jerome Powell, Fed chairman, gave a speech about the situation in the general environment for markets, the economy, and as you really enjoyed the top video recently, the JPM overview of the markets, the fundamentals, I really wanted to discuss what the Fed is saying, because watching the Fed, as Seth Klarman says in the book Security Analysis, is also now an important part of investing and thinking what can happen. Of course, hard to predict, but also that is something to predict. In that line, I want to go through 5 points that come from the Fed's letter and discuss what they are doing, how they are doing it. In that line, I want to discuss 5 points related to the Fed from their statement, from Jerome Powell's speech, to give you a, let's say, broader overview of what they are saying, how they are doing it, where they could be right, where they could be wrong. No, Jerome Powell can never be wrong. Stay till the end of the video to find out whether Jerome can be or not wrong. So the first goal of the Fed, and they say it everywhere, is maximum employment so that everyone has a job, and stable prices, because an economy needs stable prices to grow, etc. However, when I look at that, starting from the goal, monetary policy is local, national, so you can do it on one country, but employment in today's world and prices are global. I'm not in the US, and you are now watching me, for example, from other countries. I think less than 0.1% of you is from the country where I actually live. So it's global. Everything is global today. Monetary policy is extremely local. That's the first point I want to just make you think about. Then, when it comes to inflation, of course, we said prices long-term are global, but their goal is to have stable prices. And if we look at what happened with inflation, yes, in the US, they managed to lower inflation from 7.1% in June 2022 to the estimated 3.5% through September 2023. So inflation is down, but not yet close to their commitment of bringing inflation down sustainably to 2%. That's their commitment, and then it will be a bumpy ride and take some time, but they think it will happen. More about that later. However, speaking of the global, this is again from JP Morgan overview to the markets. 1.3 billion will enter the middle class in the next 7 years. 1.3 billion people buying phones, buying this, buying computers, watching YouTube, etc., etc. They are and will be a pressure on inflationary situations in the world, especially if they require higher wages to make cheaper products, not so cheap anymore, products for us. So everything is connected, and not everything can be solved with the monetary policy. Then on the labor market, the Fed says they are going to keep you employed, everyone employed, and then also they say we are going to engineer economic growth. Now, they are now looking at short-term labor market situation, so wage growth show a gradual decline toward levels that would be consistent with 2% inflation over time, but they don't want to see unemployment, just slower wage growth, so they are tightening. And when it comes to economic growth, if you read a little bit, they say that their goal to return to 2% inflation is likely to require a period of below-trend growth and some further softening in labor market conditions. So salaries going up slower, of course, if inflation is lower, but also slower economic growth than the usual trend, which is expected always to be at 2% in developed markets. But slower economies, they are going to engineer it to keep it between 0 and 2. No recession. Recessions are forbidden. We'll print money for that. And you see that if you look at the trend here, this is the trend growth, but it has been, okay, on trend, then you have a recession, and then we are back to trend. So on average, we are lower than trend. But if you look at the components of GDP, 17% government spending is that component, and the government to spend is borrowing a hell a lot of money, and the net debt to GDP is ballooning, and we know that it's already at 33 billion. So if the government is such a big part of the GDP, the economy, and they are borrowing money to spend it, they are borrowing it from the Fed that has seen its balance sheet go 10x from 848 billion to 8 trillion dollars, 10x in the last 15 years. That's money printing, and we will see how will that end up. But if you need to print money to save your government, you cannot keep inflation at 2%. Who owns you? The government owns the printing machine. So something doesn't really fit here over the long term. Then on the monetary policy, given the fast pace of tightening, there may still be meaningful tightening in the pipeline. So they have tightened, but we are now at 5.6%, 5.4%, but inflation is still above 3%, 3.5%, so they want to bring it down to 2%, and now they have to be careful not to overshoot with the tightening, to go to 0% or lower, so they have to balance things right with the monetary policy. And additional evidence of persistently above trend growth or tightness in the labor market no longer easing could put further progress on inflation at risk and could warrant further tightening of monetary policy. So they are looking at things and then saying that they can tighten more, but they will try to balance economic growth, unemployment, everything, prices. But I think this is the biggest elephant in the room, where the government depends on the Fed interest rates, costs, and everything. So net interest expense is already 10% of government spending, which is big, big, big. So I think that the borrowing will continue forever because nothing is linear. So you push, 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 everything seems okay until it doesn't. And that's something that the Fed's data models and everything cannot think. They cannot think non-linearly. And they have models based on past data where debt to GDP was ridiculously low compared to current situations. Of course, here was the war, but here we had the baby boom, technology, globalization, whatever, and that led to the financial crisis on too much exuberance, and then we have solved a debt crisis with much more debt. And then when you look at the conclusion of the Fed, they will look and act in line with the data they have, but the truth is that nobody knows, as Leonard Cohen would think. My problem is that there is data-driven linear thinking which is not prepared for an unlinear world. Let me show my thesis. This is from February 2008. Bernanke, the former Fed chair, sees no recession but big challenge. So no recession. So went to Capitol Hill today to provide Congress with an update of the struggling US economy. So very slow growth in 2008, but no recession, and that was the good news. So linear models for unlinear situations. Then let's just go to this guy, Jerome Powell. Maybe you know him. So this I found on CNN. So nice chart. 2020, we are prepared to use our full range of tools to help the economy strong, helping the economy printing. So inflation, do you remember the word transitory? Transitory. Inflation is expected to drop. This was more than 2 years ago. Inflation still is above those projections. Inflation has surprised to the upside, and now, July 2023, we will do whatever it takes to get the inflation that was supposed to be transitory down. So it's impossible to know. That is the Fed. We need to invest in a way so that whatever happens, we are okay, no matter what the Fed does. I feel they will print, but before they print money, they might push rates even higher and higher, too high. Sooner or later, they always lose control, and then they go and put the fire out, and ups and downs. For now, everything is good. They are tightening, but how high to push that, nobody knows. Should they stop? It's impossible to know. And I think it's impossible to juggle all the things: monetary policy, prices, wages, the economy, especially when you have a government that's in need of money printing, inflation to cover for the debt, etc., etc. So I hope you enjoyed this. The conclusion is, of course, nobody knows, but the Fed doesn't want to accept or come clear that they don't know. And that is the most dangerous thing when it comes to humanity: not accepting that you don't know, but pushing what you know as the truth because that is your job. Unfortunately, it is so. Thanks for watching. I'll see you in the next video.